Infrastructure debt continues to grow in its appeal to investors. A large driver of that growth is the number of potential advantages on offer. These range from an illiquidity premium over public markets to enhanced diversification, risk protection, and asset liability matching characteristics. The essential nature of infrastructure debt further enhances its appeal throughout the ups and downs of the economic cycle.
What do we mean by infrastructure debt? The definition of infrastructure debt can vary widely amongst managers, banks, and investors. For us at Barings, the definition centers on the type of asset generating the cash flow.
We break infrastructure into 6 broad categories. Economic infrastructure, such as toll roads and airports. Utilities and pipelines, or assets that carry water, electricity, natural gas, and other fuels. Power generation, such as renewable energy assets and EV charging stations. Social infrastructure, which are assets like courthouses, hospitals, or schools that a state or municipality will look to build in partnership with a private operator. Midstream and storage facilities, primarily for oil and natural gas storage. And digital infrastructure, which can include towers, fiber, and data centers.
Within these categories, we focus on what we consider to be essential assets. This means the assets meet key social or economic needs. They're important not just to the equity and the lender, but also to the core customer base. We look for assets we think will be needed for generations to come, and that therefore look like they're in a good position to offer stable, long-term cash flows for investors.
In terms of who's buying infrastructure debt, the market was once almost exclusively the domain of banks. But after the global financial crisis and European debt crisis, many banks had to pull back as a funding source. Institutional asset managers stepped in to fill the gap, with insurance companies in particular becoming a larger participant in the market.
These investors typically targeted senior secured investment-grade credit. The investments also tend to be very long-term in nature, with highly predictable cash flows that are beneficial for liability matching.
More recently, the investor base has diversified further. As asset managers and private equity sponsors have continued to develop their own infrastructure debt strategies, more investors are starting to see below IG infrastructure debt as an attractive option, particularly as an alternative to infrastructure equity.
Pension funds, for example, have become increasingly interested in the space, primarily targeting senior or junior debt with yields equivalent to core or core plus infrastructure equity. This would generally fit within the investor's alternatives bucket.
For long-term investors, private infrastructure debt offers a number of potential benefits. For one, infrastructure debt is defensive in nature. These are essential assets that are typically highly cash generative.
Barriers to entry also tend to be very high. Much of the debt in this asset class is senior and it's almost always secured. It also benefits from protective covenants that are typically tied to leverage or debt service coverage.
These covenants give private investments, like infrastructure debt, a seat at the table ahead of public bonds, allowing for exit, repricing, or renegotiation in times of stress. As a result, the asset class is in a strong position to weather economic turbulence and has historically performed well during recessionary periods.
The high quality of infrastructure debt and the essential nature of the services provided has resulted in a historical record of low losses, high recovery rates, and low ratings volatility. Over the last 40 years, cumulative defaults on BBB rated infrastructure issues were below those of single A rated investment grade debt.
Another key benefit of infrastructure debt is the potential illiquidity premium versus public markets. Since debt issued in the private market tends to be less liquid than that issued in public markets, infrastructure debt has historically offered enhanced yields versus investment-grade credit to compensate for that illiquidity.
The complexity inherent in underwriting the credits adds to the potential premium. And historically, the asset class has offered a meaningful illiquidity premium over both investment-grade and below investment-grade credit.
Diversification is also another consideration. Infrastructure debt can be an effective diversifier in a portfolio that already includes more traditional, long-term fixed income assets, such as sovereign and public investment-grade corporate bonds, as well as direct lending.
In addition to being a global asset class, infrastructure projects span rated and unrated public and private debt, as well as a wide range of industry sectors and subsectors. All of these areas exhibit unique return profiles.
It's an exciting time for infrastructure, and the opportunity in the asset class isn't likely to fade anytime soon. There is a global need, not only to replace aging infrastructure, but also to add new types of infrastructure to meet evolving needs.
By some estimates, an investment of $94 trillion will be needed to meet the demand for global infrastructure through 2040. That's an average of $3.7 trillion a year, which is almost 20% higher than what is currently being spent.
Clearly, governments will not be able to meet the growing demand alone, and private investment, often in conjunction with government spending, will be increasingly necessary. There are also a number of trends supporting the evolution of infrastructure debt and driving the continued opportunity. Arguably, the biggest is the transition to renewable energy sources.
Environmental and climate change considerations have perpetuated a massive shift from coal and oil to cleaner power sources like solar, wind, biomass, and hydrogen.
Even nuclear-powered electrical generation is attracting renewed attention. With the focus on decarbonization globally, this trend isn't likely to go away overnight, and it will require continued investments in the assets necessary to support the transition, from wind turbines and solar panels to storage facilities and pipelines.
Efforts at decarbonisation coincide with the movement to an all-electric economy, which is chiefly affecting power generation, transmission and storage.
Think of how the popularity of electric vehicles is creating demand for charging stations and upgrades to distribution grids. Electricity-related demand for infrastructure investment is coming, and that could range from electric storage facilities to transmission lines from wind and solar farms.
Government policy is another opportunity driver. Governments around the world have made significant funding commitments following decades of underinvestment in bridges, roads, airports, and other critical transportation assets.
In the US, the government is committed to massive spending on infrastructure over the next 5 years, including $110 billion on road and bridge repairs, $65 billion to upgrade the nation's power grid, $65 billion on broadband infrastructure deployment, and $55 billion on clean water infrastructure.
It's a similar story in Europe, where the EU has committed to making 135 billion euros available for investments in infrastructure projects through 2027.
These programs create a wide variety of opportunities for investors to leverage federal spending in ways that are likely to produce attractive returns within a range of acceptable levels of risk.
A final opportunity driver worth highlighting is the accelerated pace of digitization throughout the economy. This is driving demand for investments in data centers, cell towers, fiber optic cabling, and other necessary building blocks of digital infrastructure.
As a result of this acceleration, telecom-related deal volume grew 4% in 2015 and 16% at the end of 2022.
Historically, infrastructure debt has not been readily available for most institutional or individual investors. Large institutional investors have typically accessed the market primarily through separately managed accounts. That said, more funds have emerged in recent years, allowing smaller investors to participate.
While there are select opportunities in the broadly syndicated markets, the vast majority of transactions in this asset class are directly originated and privately negotiated.
Because it is a private market, it relies heavily on having relationships. And there are a few main channels for sourcing deals. One is directly with infrastructure sponsors, which has been a fast-growing segment of the infrastructure universe. Another is via the traditional bank market, where you may see deals that banks themselves lend to and then look to distribute to investors. We also see opportunities in which banks and financial advisors are working on behalf of a sponsor to arrange a debt financing.
Given the characteristics of this market and the fact that most deals are directly originated and privately negotiated, selecting the right manager is critical to accessing the best opportunities.
So what characteristics should investors look for in a manager? A strong origination platform is one. In this asset class, access is key. And managers that have strong, established relationships with infrastructure sponsors and other market participants are often much better positioned to access opportunities and source the highest quality deals for the investors.
Experience in the market is also critical. At the end of the day, this is an illiquid and often opaque asset class. To that end, investors can benefit from working with managers who have a thorough understanding of how to structure deals and put appropriate covenants and protections in place. Experienced managers often have a better sense of market direction as well, which is helpful in determining appropriate pricing.
And then finally, a global presence is important. Infrastructure opportunities exist around the world, and each geographic region poses its own unique challenges. Managers with a full-time presence and experience in the US and European markets therefore are best positioned to source the most attractive deals and identify the best opportunities for investors.